Good afternoon. Peter Klein, Aligned Wealth, Chief Investment Officer and co-founder. This afternoon, speaking with you about our market and economic conditions report. Today is the 26th of May, and we hope you guys are well and recovering and getting excited for what will likely be a very interesting next few months. So without much to do, allow me to share my screen and we will proceed. So here we go, and you should be able to see in front of you. Yes, at this point, yes, okay. Great, so let us proceed. Here you'll see our Aligned Wealth roadmap, and you know, we use that roadmap. My partner, Mark Kravitz, speaks well of this. We use that roadmap to describe what we do for our clients. We take them, we work with them, we provide them guardrails to the twists and turns to their financial lives. We partner with them, we co-pilot with them. Perhaps we're the navigator, but that's the key to the twists and turns of the road you often see on our stuff. So next slide, and I guess I'll have to go this way. There we go. So our take, very simply, is that we believe there's a reopening enthusiasm and excitement. But again, the question is it already baked into the price? We're always saying that. We're always thinking, because you know what? That's the bottom line. The bottom line is what you pay for something. So we're always mindful of that. We're mindful of, wait a minute, does the price already reflect that? We'll get into it. This is this generation's Great Depression or post-World War II or the 1970s Vietnam inflation era. This is our period, our era, you know, before COVID, after COVID. It's like sort of our thing. It's not going to be forgotten anytime soon, of course, and rightly so. And there's going to be trends that come out of this era. We'll discuss them. I want to get into this idea of innovation. It's so damn exciting. The heading of our talk tonight is between inflation and innovation. So I want to talk about that as well. This idea that perhaps the market is self-correcting slowly. Maybe it's not a pop of the bubble, but rather one which is slowly coming out. And that would be positive, of course, for markets. So we'll see. We want to talk about inflation and the three buts. We'll get to it. What a true fiduciary is doing to protect their clients' assets. And then finally, where are their opportunities? So let's see if we proceed. We do. Reopening in China. Here we go. Okay, it seems like China has taken the Emmanuel quip about crises and waste to heart. They are certainly not wasting any crisis. If you think about a geographic wave of COVID starting in late 19 in China, sweeping west, right, through Europe, right, and then of course to our shores here in the US, then down to Latin America, and then through India, and then maybe back, well, hopefully stopping there, and as vaccinations move along as well. So clearly China was, we'll call it FIFO, right? First in, first out. What are those implications? What are they doing? And if you look at some of the data points, like their Singles Day, they call that, you know, November 11th, we call it Veterans Day, or otherwise known in my house as my wife's birthday, as they call it Singles Day, being very number consistent there and very number centric rather. But in 2020 in China, the 11/11, so the second largest online retailer is racking up record sales. So the two largest online retailers, record sales. So the consumers in China were back, and that was, you know, November of last year. So you could see how they're ahead of the sort of curve a bit, owing to that first in, first out factor. And in September of 2020, even before then, while in the United States about 33% of the consumers reported resuming out of the home activities, in China it was 81%. So they were out of this, you know, as early as the fall of last year, or at least coming out of it. And we, again, there's always the question about Chinese data, so we need to put a little asterisk there. France was 49%, and but Mexico, going to that again, that wave down in Latin America was only 18%. My colleague Brian O'Leary likes to use the term urge to splurge, and when we're talking about consumers and the activity, some data points for you to think about. In April 2020, household savings peaked at $6.4 trillion. Subsequently, 3.6 trillion of consumer spending has been unleashed since then, and that's equivalent to 7.5 times the historical average. So a lot of spending coming out since mid-late last year. It's also important to note that consumers' balance sheets are stronger than ever, right? And so especially those, if you look at it in the bottom half of the economic scale. So it's really interesting. You have these two long-term drivers coming into play. Now this, you got to talk about sentiment, folks, because that's what moves markets. Like fear and greed, right? Where are we on that? And we use the sentiment. We look a lot. We look deeply into sentiment indices. We want to understand what the mentality of investors are. And right now, it's unabashedly, for the last year, bullish. And frankly, that gives us some concern and some pause, because if everybody's already in there, then who's the next marginal buyer, right? So here's a little graph chart that shows you the amount of capital flowing into equity funds over the last 12 years combined is significantly less than the last 5 months. Let me say that again. Take all the money that's been moving into equity funds since January through the end of April, or beginning of April, excuse me, and then compare that to all the money that has flowed into equity funds for the last 12 years. I mean, come on, that tells you everybody's in the pool, So this is a pause, and then of course we have the speculative froth, right? I call it options, IPOs, and SPACs. Oh my, here you have the amount of option volume. Options are a proxy for speculation, right? You're buying options, you're likely speculating. And then you have IPO activity and of course SPAC activity, which has come down a little in the last few weeks. Well, I should say the activity the issuance may not have come down as much. Some of the prices of SPACs have. Okay, let's go back 100 years, the last pandemic, and let's see what the mentality then was. And so one of the things that we looked at when you look at the economy shutting down in 1919, drastically reducing industrial capacity. Again, clearly it was a different economy, a different world. But some of the things that I think are important is that post the Spanish flu, 1919, we had pretty much a resurgence in labor strength. There were strikes. There were labor demanding more pay, and I think that's probably something we need to keep an eye on going forward. Is the shifting from capital to labor. Now, labor may have the upper hand, and maybe that's going to have, and you add to that the progressive movement of the current administration to some degree, and you seem to have a setup here that can lead to wage inflation. And here you go, you'll see some inflation statistics here. We'll get into this as we move along. Okay, some other more exciting perhaps trends post-COVID is this innovation trend. Online services, remote learning, AI-enhanced optimizations, telehealth, of course, biopharmaceutical breakthroughs. We'll get into the golden age of medicine, I believe we're embarking upon. We're seeing a lot of that. We're seeing a lot of new businesses starting. And in France, witnessed a huge growth in business formations late last year, as did Japan and Germany. I believe you could say that yesterday's small business owner has been re-optimized as today's entrepreneur. They've realized that they've been perhaps spending more, their businesses were more costly than they needed to be. They pivoted, they went digital, and they're probably doing better in many cases, or as good, and then they were, and maybe they're more scalable. Maybe they could grow faster. So a lot of things are cooking in there, and this entrepreneurialism is very exciting. The rise of digitalization, AI, and machine learning. We've spoken about this before as it relates to technology and the intersection of tech and healthcare. Real interesting stuff. So where are we, right? Where are we? We're between, in our view, we're between inflation pressures on one end and what that might mean for rates and multiples, etc. And remember, this market is very hinged on low interest rates, right? And on the other hand, we have innovation and entrepreneurship and the unleashing of all the growth and opportunities that might make. But we're also doing that in a world that's becoming increasingly crowded, hungry, and difficult to grow food on. So, hot. And so there are some, multiple movements in this paradigm that we need to look at. So how do we balance it? Here we are in the catbird seat, managing our clients' capital and protecting their long-term portfolios. We like to use the term, 1 foot on the gas and 1 foot hovering over the brake. No way to drive, but it is a way, I think, to manage portfolios. And what we're trying to do here is to push the growth as much as we can by finding special situations and undervalued assets, and to also keep a fair amount of capital at bay, dry powder, if you will. That's our brake, that's our protection, that's our ballast. We used to be able to use fixed income for that, folks. No such game in town any longer. The 35-year bullish of all bull market in bonds from 82 to now is over in our view. Rates are likely to gravitate higher over time. And so no place to hide. Every correlations are way up. We use that term R squared to look at correlations between asset classes. You used to be able to diversify. You used to be able to have a portion of your capital in fixed income, and that would return a certain percent, it's called 4 or 5% to you. And I could go back even to the days of higher returns on bonds. And today you can't. And so it becomes difficult to diversify. And that's what we have, RIP diversification down there. Okay, so what's next? So we believe there's a shift underway in the technology sector. We think that the huge amount of companies that have negative earnings is concerning. And so we want to be mindful of companies that are trading without earnings, companies that are trading at huge multiples to their sales. These are pushbacks for us. These are pause buttons for us. Because in the end of the day, we're mindful of what we're paying for assets. Remember, we are doing this for you. So obviously, we want to make sure we do it right. And we're not swinging for the fences, but rather looking to, get on base and score carefully. So that's one data point. And then we've got how the technology sector on its own has really, been straight up since 08, 09. And so maybe it's time to pause, or maybe it's changing. Maybe it's less, enterprise software as a solution kind of, or a service kind of sector. And maybe we're moving more into biopharmaceutical, this intersection of healthcare and technology. Maybe that's the new technology. And as you could probably suggest, we believe that might very well be the case. And so you'll be hearing more on this as we move along in the next few months, but we're seeing something that's exciting in what's been known and discussed as the fourth industrial revolution. We've written, we've spoken about it from time to time, and we believe that we're there now. And the fourth industrial revolution is more about connectivity and sensors. 5G is certainly going to help there in a big way. Of course, we need cybersecurity. One of the things I think about as the sort of quintessential example of the fourth industrial revolution is, let's say you're wearing you're wearing a monitor on your body that's monitoring your blood sugar, monitoring your heart rate, and knows all about what your health and your issues. You have an app on your phone. This is here already. You have an app on your phone that monitors all this. It goes to the cloud that your doc can plug in and see. And so you've exercised today, and it monitors your exertion, your exercise, the whole ball of wax, right? And then you go to a restaurant and you use your phone to sort of scan the QR code that's become so ubiquitous since COVID. And now so now what's going to happen is that your health is going to look at the food options, and it's going to say, you know what, you probably should eat the salmon rather than the steak, and then kill the potato, get some veggies, and then boom, it automatically orders for you. Maybe that's a little far-fetched, but who knows? It's like, this is what's happening. This is the fourth industrial revolution, right? This is the kind of interconnectivity that we're going to see more of. We're also going to see more of biology, guys. We believe we're in the golden age of medicine, right? This 22 years ago, we started mapping the genome, and now those takeaways are giving us the opportunity to make drugs in 11 months to save the world. I mean, that's what it comes down to. They had COVID mapped in a couple of weeks. And now all you had to figure out was, okay, now let's get this messenger RNA in there and figure out how to sort of stop the virus and how to replicate it to get antibodies. I mean, again, I'm simplifying it, of course, but this is the future, and it's exciting. Wouldn't it be amazing if we have one disease after another clicked off? But that would be amazing. And maybe we're on the forefront of that. Maybe this is the beginning of a combination of an intersection of both the speed of technology and the human genome, and the understanding of that and the intersection of that could really yield some dramatic results. So we're excited, as you can see here in the slide, about cell therapies and gene therapies. We believe there's a future there. We're investing in allocating your assets that way carefully. Okay, but there are three issues. And the first of those three issues is valuations. Every time we speak, it's always the same thing. Klein always talks about valuations because they matter. Price matters, not in the short term. Short term is noise. Anything can happen. But what we can control as advisors, as allocators of your assets, is what we pay for the investments that we put you in, that we invest in for you, on your behalf. And as fiduciaries, we're always mindful of our obligations of putting you always first and second and third. That's our motto here at Aligned Wealth. So the first issue we have is valuations. And you can see here from the chart in front of you, the Shiller index, cyclically adjusted price to earnings ratios, nearly all-time highs. And this first one shows you the years. This shows you the decades. We're in rarefied territory, folks. And this is a Nobel Prize winning research by Professor Shiller from Yale. Let's make sure we understand what's happening here. We're stretched, no doubt about it. As you can see in the price to sales ratio, one of the most mean reverting statistics we have in finance, price to book ratio through the roof. Folks, we're stretched, no doubt about it. So price to sales at 2.86 times, PE multiples 24 times, price to cash flow 30 times. I mean, come on. These are high numbers. These are averages, So in the Buffett indicator, right, when you look at the total market value versus the GDP, 190% all-time highs. So that's number one, valuations. The price is there. So now that means that we've got to work just as harder to find those asset classes or those investments that are misunderstood or mispriced for whatever reason, do our research, roll up our sleeves, peel back the onion, and get in there and figure out, okay, why is it? Is the risk minimized versus the return opportunity? And if so, let's leg into it carefully. Number two, debt. Again, you hear this a lot from us. We're concerned about it, and you should be too. I mean, look at this. This is the gross federal debt, and it shows you, a fairly substantial increase. As you can see here, these numbers are extraordinary. It used to be that clock. My first apartment in the city after college was on 44th Street off of Times Square. That's all we could afford. It was not the nicest area, but they had that debt clock right there. And I guess it was maybe, I don't know, maybe a few years ago, they took it down because they didn't have enough digits left. 49 trillion, billion, trillion dollars, $49.7 trillion. The globe, globally, we're at 300% of GDP. If you add up all the debt, including student, corporate, muni, et cetera, but $86 trillion, or 4 times GDP. And that's about $1 million per household, folks. That's why you should care. About $1 million per household. Those same households, by the way, on average, have about $33,000 in savings. Sounds like a little upside down to me. Now let's look at Uncle Sam's checkbook, and we look at deficit spending, and we look at this is just the back of the envelope thinking from our friends at Horizon Kinetics. But if you have about $3.45 trillion coming in tax receipts, there's about $3 trillion in known spending, and you're left with $500 billion or so in discretionary income to spend. We don't know what that is from different programs, be it stimulus or government pensions or classified programs, but it's some number. Then minus from that, the $397 billion in interest expense, which maybe go higher if rates go higher, and you come out with deficits, for years to come. Again, this is hard to understand how to get around this, and so we're looking at about 4.1 trillion or 16% of GDP in 2021. This is, in our view, unsustainable, and it likely means the dollar will continue to be weak, which then means we should be looking for opportunities that play into that, and we are. This is a hard to read slide, but just gives you the sense of the president's infrastructure and family plan spending. It's about $4.2 trillion. Who knows where it'll end up, but it'll be substantial. And then, of course, the investors in the game too, with margin debt. Now, again, let me say for the record, some margin debt at these low rates are potentially attractive. You use it for a one-off or a short-term bridge loan. It's very small versus your assets. You're doing it in a responsible fashion, especially if the rates are very low. It, however, can be a problem if you go too far with that, and that's where I get concerned. And it does look like there's a lot of investors using margin debt perhaps irresponsibly, and that's where I think you get a little bit concerned. I get concerned. Okay, number 3 issue: inflation, the beast that eats away your buying power. So here's inflation expectations. You can see how they've gone straight up since the COVID last year. And the monetary base, as you know, is up 27% year over year. Never happened before. CPI up 2.6, highest reading since 2012. I think there is a separate reading after this February date of this slide that was 4%, the most recent CPI, which is the highest since 1982. So inflation is picking up. And I use the term toothpaste and genies, referring to the fact that once inflation comes out, it's like toothpaste. It cannot get back in the tube, or the genie can't get back in the bottle. I'm reminded of that I Dream a Genie program when I was a kid. That was a lot of fun. But yeah, that's what I mean. Inflation, when inflation comes out, you can't stop it. It's hard to stop. Oh, it can be stopped, as Chairman Volcker did show us in the 80s. but it requires the Fed to be aggressively unstimulative, right? Aggressively hawkish, and that is not, and that's something that investors are not putting in their models. So that's the concern, is that inflation does get out of hand, and the Fed's behind the curve, and it's not transient, but it's actually there. And once it's there, you can't get that toothpaste back in the bottle so easily. I believe labor is gaining the upper hand. As I said earlier, labor versus capital. I think we have a likelihood of increased labor, wanting more wage inflation and the like. So expect that. And again, that would hurt consumer companies and those companies that have a lot of labor costs. Commodities, certainly something to be looking at, especially if we believe inflation is going to be increasing going forward, and we are looking at commodities. So you should see that in your portfolio and more of that going forward. And this is a slide that shows you the different asset classes over the years for the last 10 years. And I want to point you to the fact that commodities have been essentially in the bottom rung all for the last 10 years. Only now, year to date, 2021, have they popped higher. So this regression to the mean issue is an important one to remember. And I think we're seeing evidence of that nowadays. And they've got a lot of making up to do. And the old alligator jaws that we've spoken about time and time again. When one asset class goes way above its mean and another one goes way below its mean, watch out when those jaws close and the one on top goes down and the one on bottom goes up. So we expect something of that going forward. Okay, so what is a fiduciary to do in for a conservative client's portfolio? And a lot of it is looking and seeking out uncorrelated asset classes. Not easy to find. We do a lot of work to do that and to find the right investments for the right time, and make sure we stress test them time and time again. Hey, we're not infallible, but we will make sure we do our work to make the likelihood of winning higher than lower. Active management, being there every day, proactively watching portfolios. Embrace robust risk management, watching the downside, making sure we have dry powder, making sure we have uncorrelated asset classes. That balance that we've spoken about between risk and return, 1 foot on the gas, 1 foot hovering over the brake. Buy what's out of favor. Contrarians typically do win over the longer term, not the shorter term. So again, these are just some additional themes that we've spoken about before: the 5G, the intersection of healthcare and technology. We find a lot of dividend growing companies, that grow their dividends consistently, being interesting in here. And the water sector, which we'll get to in a moment, is very exciting. So here's water for you folks, just to round it out and finish the program today. This is a sector that many of you know that we've been focused on for the last decade plus, and to much of the enjoyment of our clients. Great companies. The economics of the water sector are so compelling. You have an asset that's essentially needed for everything, that's becoming scarce, and demand for it's becoming higher. So you can't get a much better economic backdrop than that. We believe there are strong opportunities in infrastructure, especially with the expected spending in infrastructure going forward. Water, I think, is one of the top areas that we're looking at, or that the administration is looking at to focus on, and it sorely needs it. Testing, metering, desalinization, these are all opportunities. So here you have it. This is a nice little summary slide that shows you the fact there's no substitutes, that there's very little of it, and it's probably getting more scarce as the ice melts up in the Arctic region. Climate change is affecting obviously the water available to drink, and of course you have infrastructure, which is a lot of capital will be spent in infrastructure going forward, and that's where we want to be. We want to make sure that we have exposure to those companies. And as you know, many of the companies you have in your portfolios are there. This is a slide that speaks to the nexus of energy, food, and water. There's so much water that's required. Folks don't realize this in production and obviously agriculture, but maybe you don't realize how much is needed in agriculture, and of course in industry and in energy production. So it's a critical resource, and unlike oil, it is not priced or traded yet. That might be coming, so stay tuned. So we just see this as an opportunity to have an asset class that's going to be bigger in the future. And here's the slide that talks about the leakages in water main breaks. You hear about that all the time in the city. And the reason is that these pipes are hundreds of years old in some cases. And the infrastructure is so bad, and they're afraid to touch it, because once they touch it, it crumbles. So there's a lot of spending that needs to be done. EPA estimates over 644 billion is needed for drinking water and wastewater infrastructure over the next 20 years. And if you add on other locales around the world, and of course other parts of it, metering, desalinization, etc., that number could be much higher. So and then here's our last one on water. So the three areas that we're focusing on: quality, efficiency, and supply. And again, these are companies that have been solving water or trying to solve water issues for years. And we believe that they have what it takes to do so. It won't go straight up, nothing does, but we think that the water sector is compelling, and we urge you guys to talk to us about it so we can dig in and discuss it with you and lay out our thesis. Thank you very much for your attention today. I certainly welcome it and welcome your questions at Align Wealth. Feel free to drop us a line, give us a call, email us, or visit our site. We're here to serve and look forward to doing so. I want to wish you all a safe and happy and perhaps even somewhat jubilant Memorial Day. Let's not forget those that have suffered during these difficult times as well. Thank you, and look forward to chatting with you again soon. Take care.